Hi, this is Andy Filipiuk in Toronto for the week of February the 7th. Well, I waited till Thursday of this week to do this video, wanting to see what the U.S. inflation numbers were. Well, they came at now a 7.5% year over year, up from 7.1% last month. And surprisingly, this was supposed to be a month, meaning January, where the inflation rate may have come down somewhat. So the trend of higher inflation continues. Now, we haven't had a rate hike from either our central bank here in Canada or the US, but what I've done is show a chart of what the 2, 5, and 10-year bond yields were in Canada at the start of last year and where they are now. Now, what this is the market's way of building in higher interest rates. For example, with inflation rising throughout 2021, bond yields started to rise, primarily at the start of this year, however. So the market is already building in higher interest rates, and they will in fact force the Fed in the US, the Bank of Canada here, to have to raise rates as they go higher. So it looks like come March we're going to finally see rate hikes by both our central banks to try to fight this inflation. Now the real problem is, given how high the inflation rate is, what happens if the authorities lose control of the bond market? For example, bond yields continue to rise higher and higher despite the central banks telling you they're going to raise rates. That could create a tremendous economic problem, as every year, for example, in Canada, or at least this year, 43% of all mortgages will come up for renewal. And we have over 40% in variable rate mortgages. With rising short-term rates, that's going to cost borrowers a lot more. That increase in interest rates coupled with higher energy prices could put a real dampening effect on the economy in 2022. So we'll continue to watch, and thank you for watching.